Greetings from your 401k investment advisor, Scott Campbell. The rally continues. The U.S. stock market was up 8.2% for the third quarter of this year and is now up 14% year to date. That's pretty spectacular considering the market was down over 5% in the first quarter. Bonds also produced positive returns in the third quarter. Short-term bonds were up 1.19% in the third quarter and up 4.14% year to date. Intermediate-term bonds were up 1.51% in the third quarter and up 5.36% year to date. Long-term bonds were up 3.16% for the third quarter and 6.64% year to date. Rate cuts are helping bond markets. The performance of bonds has slowly, hopefully, returning to normal by long-term standards. The stock market has been quite strong. The S&P 500 sets new record highs on most days. The market closes higher. The rally is being driven in part by strong earnings expectations. Analysts expect roughly 9% year-over-year earnings growth for the S&P 500 this year. Earnings are the fuel for the stock market. Ultimately, earnings drive the performance of the stock market. Earnings are net profits earned by public companies, so it makes perfect sense profits drive the stock market. Following the trend of the past few years, the Magnificent Seven and other large cap tech names are also pushing the rally. Valuations, or stock prices, are considered high by some measures. As always happens when a rally continues for an extended period, some analysts fear the market has peaked and we're due for a correction. The people are always looking for the negative. No one knows, but even if true, market corrections are buying opportunities. They pass quickly and the market always moves higher from the low. An update on tariffs. Tariffs have brought in over $165 billion in revenue to the U.S. Treasury. That's actual money. Word is they're going to start using that money to pay military people during the shutdown. Foreign companies have committed to invest trillions of dollars, starting and expanding operations here in the U.S., all to avoid the tariffs. Tariffs have protected domestic industries. For example, the steel industry has reduced imports while boosting domestic production. Trade deals are slowly being done. Some trading partners are very stubborn, but the U.S. is the most lucrative marketplace on the planet. We're spenders. We have more money and a greater penchant for spending than any other economy on the planet. Foreign manufacturers need to sell in the U.S. to generate the revenue they need to be successful. Current inflation is about 3% right now. That's right about the long-term trend. Clearly, inflation has dropped since the current administration took over, but prices still remain too high. Inflation is in check, and to date, tariffs have not brought about the widespread inflation the talking heads and mainstream media told us were a certainty. Real GDP growth, that's the economy, is moderating. Q2 saw a strong rebound, which was revised upwards to 3.3% annualized. GDP contracted in the first quarter. The consensus for Q3 and beyond is a slower pace of growth, which follows normal seasonal trends. The U.S. economy always slows during the summer months. Employment remains positive but slowing due to the normal summer slowness in the economy and the removal of illegal immigrants. However, the latter appears to be temporary. Data shows the percentage of U.S.-born workers increasing. The Federal Reserve cut the base interest rate by 0.25%. Future rate cuts are expected, which will help the economy, the stock and bond markets as well. The current federal government shutdown is having very little impact on the stock market. These markets have seen many shutdowns come and go. They rarely last and are quickly forgotten once resolved. It is interesting to note that the Democrat Party is pushing to add back spending cut in the Big Beautiful Bill. I will remind everyone the federal government still remains $37 trillion in debt. This debt will crush future generations. Now we head into the fourth quarter, which historically is one of the best quarters for the stock market, because corporate earnings or profits, as we discussed earlier, are usually very good in the fourth quarter due to year-end and holiday spending. That's my wrap-up for the third quarter. Hope everything's going well. If you have any questions or need any help, please reach out. Thanks.